You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 12th of October 2025, and I'm joined today by my co-host John McEwen. And in this week's episode, we'll be discussing Imperial Brands, Card Factory, Greggs, DFS Furniture, Unite, and World Chess. Before we dive in, however, just a quick shout out to the listener that sent a copy of The Match King for us to read. So I've read it and it's now going to get lent to John very shortly. But yeah, really enjoyed it. For anyone who's not read it, it's about a guy called Ivar Kruger, who was a Swede, and he basically founded Swedish Match, which you may recall was actually publicly listed until very recently when it got bought out by Philip Morris. So they did, I think they did the Snus, but back when he had it, it was just literal matches, hence the name. So yeah, really enjoyed it, and thank you very much for sending it in. If you would at any point like to meet up for a drink or anything, do get in touch. And if nothing else, if you could just send me your reading list, please do, because I think you've sent quite a few good books now. Do you want to start with a stalwart of the show, Imperial Brands?
Yeah, so it's the UK's second largest tobacco company and the world's fifth largest. They had their full year trading statement out last week, with the group expecting to report underlying revenue growth in the low single digits for the financial year just ended. Underlying operating profits have increased at a similar pace to the 4.6% seen last year. Strong tobacco pricing has more than offset volume declines, which have eased in most regions. Revenue growth from next generation products was around 13%, and Imperial announced a £1.45 billion share buyback to complete by the end of October next year. And the shares were up around 3% in early trading. In terms of valuation, Imperial Brands has a market cap of £25 billion and trades at 8.8 times forward earnings, which is broadly in line with the 10-year average, and it has a prospective dividend yield of 5.7%. I thought these results were fair and in line with expectations. It's interesting with Imperial because the next generation products are a smaller part of Imperial Brands than they are for Philip Morris or British American Tobacco, and they're actually yet to turn a profit. I think one thing, perhaps you picked up on this more, Sam, with Imperial Brands, is it's almost like they've accepted that the company is sort of in structural decline, and they've been very clear about returning cash to shareholders, both in terms of dividends and in share buybacks. And that's probably been the most aggressive of all of the big tobacco companies. So actually, if you look at it on a 5-year basis, it's had a pretty stonking 5-year return. We'll see what happens going forward. I mean, it looks like this is probably going to be how they continue. They have got a new chief executive, Lucas Paravinci, so we'll see what his approach is. I mean, this is on the background of around 10 years ago, they paid an awful lot to buy Blue, which you might see in WH Smith. It's sort of an e-cigarette from Reynolds, which was nearly 10 years back now. And they are still paying off the debt from that. But it's got quite it has had quite a clear strategy. Yes, it's got the next generation, but it's been returning aggressively to shareholders. I think that's probably why you've seen such a good return on the shares. In terms of the valuation, it doesn't sound particularly high at 8.8 times forward earnings. I think that 10-year average is skewed back really by the start of the 10 years, because it's certainly been a lot cheaper at times over this last 10 years. But overall, I don't think there's much surprise here from the results. I think the market is probably taking a different view, and a different view to it, how it was perhaps 5 years ago. And it was almost like these companies were priced as though they were going bust in a couple of years' time rather than in 10, 15, 20 years' time. And I think that's probably why you've seen this revaluation. It was also interesting probably going back maybe 5 years, because you saw a lot of the institutional investors selling out for ethical reasons, ESG, and that's, I wouldn't say they're necessarily buying back in, but you've seen that sort of re-rating, because I think there's that additional downwards pressure on them, quite apart from overall sentiment. There was the ESG component to it. Sam, what's your take on this trading statement and Imperial Brands?
I think it's a pretty good statement. I always find it weird when the companies insist on releasing a statement to say everything's kind of in line with what they'd guided for. But I suppose they were like getting good news out. I think that's part of it. Pretty solid set of results, if unsurprising. I think the 13% increase in next generation is quite good, because I recall, I think British American had lagged, that dropped next generation for British American last time we covered it. So I suppose it's a fairly decent growth rate, but probably not what it should be. That being said, the amount of cash they're returning is great. That's really what it's mainly about. I think at a prospective yield of 5.7%, though, I think you could probably do a bit better, although you are getting the buybacks as well, I guess. So if you factor that in, it's probably quite a bit higher. It's difficult with the tobacco companies at the minute, because I think we've kind of gotten used to seeing them quite low at a P of around 6. Imperial Brands is now 9. British American is about 10. And I think in relation to Imperial Brands, British American is probably okay, because I think it's a slightly better quality company. But I'd kind of gotten used to seeing them around 6 or 7. So I don't know if it's just that they were probably absurdly cheap, because they were priced as if they were going to zero a lot sooner than they probably will. And maybe we just need to get used to seeing them at what are actually probably fair valuations. But yeah, it would be difficult for me to, I think, purchase at these valuations when I have got so used to 6 times earnings.
I mean, if you exclude the dividends, which obviously have been pretty high in the last 5 years, and they'd have been high single digits, if not double digits over that time. If you exclude those, the share price alone is up 132%. And you include the dividends, and that's significantly higher. So I think they probably, if you looked at the last 5 years, be some of the top performing stocks in the FTSE 100. Which is
but I think a lot of that has come, obviously they're great at retaining cash, but a lot of it has come from valuation increase. It's difficult, because the issue is, I think if you compare them to, say, their American peers, you could argue they're actually still undervalued. Like Philip Morris, that's like 15, 16, 17 times earnings, I think.
Well, I think that's the other thing that always comes into the conversation with Imperial Brands, is it's not big, and does one of the really big players pick it up? And particularly when it's listed in the UK and it doesn't trade at commanding valuations.
Yeah. Although I guess the time to do that probably would have been when it was at 6 times earnings.
Well, no, that's right. And also, I guess you come to Philip Morris and they would say, well, they're trying to transition more into the non-combustibles. And Imperial Brands is more of the traditional combustibles.
Yeah, I don't think they'd pay a huge amount for blue, although Imperial Brands did, so you never know.
Well, they did, and it was interesting. It was from Reynolds, which then British American.
It's part of that now, isn't it?
Yeah, it is, exactly. And you've read all about Reynolds in Going Down Tobacco Road, which was another
absolutely.
list of recommendations.
Obviously, Swedish Match, which is now part of Philip Morris.
Yeah.
Should we move on to Card Factory? I think it's a debut.
I think we've covered it once before.
Oh, have we?
Yeah. It was a while. It was some time ago, though.
Okay, right. Now, in fairness with Card Factory, so the market cap's about 330 million, so it's not quite FTSE 250 level, but I imagine it must have been in the FTSE 250. In fact, it's come down quite a bit, so it will have been in the FTSE 250 probably around the time we started the show. So
yes, that's right.
Maybe having it and it's dropped out and we've not noticed. But anyway, so we're doing Card Factory. Anyone in the UK, obviously, they've got all the shops where you can go and buy a card, clues in the name. They have come out with their interim results, and revenue was up 5.9% to 247 million. Adjusted EBITDA was down 2.4% to 44.2 million. And they've said that the adjusted measures exclude the impact of one-off items totaling 5.7 million. This includes the amortization of acquisition of intangibles, revaluation of foreign exchange derivative instruments, and one-off acquisition costs relating to the post-balance sheet acquisition of Funky Pigeon, which we'll get to later. So I think those adjustments seem pretty reasonable. Adjusted profit before tax was down 9% to 13.2 million, and adjusted earnings per share was down about 10% to 2.8p a share. Dividend per share was up slightly from 1.2 to 1.3p a share. Net debt excluding leases was up 5.3% to 78.9 million, and the adjusted leverage excluding leases was up 0.1x from 0.9x to 1x. Cash from operations was up 74.3% from 17.5 to 30.5 million. And for the statutory figures, EBITDA was down 13.7%, profit before tax was down 46.4%, and the basic earnings per share was down 46.7%. Total store revenue was up 2.9%, including the contribution of 30 net new stores year on year, of which 13 were opened in the half. Card Factory is not actually a business that I would have expected to be still opening new stores, so I suppose that's quite good. Like-for-like store revenue grew by 1.5% in line with the non-food retail sector and against a backdrop of softer summer high street footfall due to the hot weather. They said encouraging performance from recently acquired businesses in North America and the Republic of Ireland are in line with management expectations. Total partnership revenue in the period was 16.5 million, and that compares to 6.6 million a year ago. And the newly acquired businesses performed well and contributed positively. Like-for-like sales at Card Factory were down 11.3% as they continue to evolve to focus on higher margin sales. And they've said they've made a decision to bring forward efficiency-focused investments, including upgrade to point-of-sale till system, contributed to adjusted profit before tax for the half, being down 1.3 million to 13.2 million. They've highlighted the significant improvement in free cash flow was mainly due to improved working capital, which went from an outflow of 24.9 million to an outflow of 7.5 million. And they said they've also approved a plan to purchase shares initially to satisfy employee share scheme awards to avoid equity dilution. So they're going to do a buyback, but because they've issued shares to employees, all the buyback's going to do is cancel out the extra shares that go to the employees. And following the cut-off date for this interim results of 31 July, they have announced acquisition. Well, they've completed the acquisition of Funky Pigeon. That was completed in August, and that saw them become the second largest online card and attached gifting retailer in the UK market. So interestingly, they bought this off WH Smith. I didn't realise WH Smith actually had this. But anyway.
And I think WH Smith have been under quite a lot of pressure recently, so you do wonder at what price they sold it for.
So they sold it for 24 million. They've said the acquisition will accelerate the existing digital strategy, providing a platform for online growth, particularly in the direct-to-recipient card and attached gifting market. The group expects the acquisition to be earnings enhancing in the financial year ended 31 Jan 27, the first full year post-completion. Work is now underway to unlock annual synergy benefits of more than 5 million, which will be achieved by the end of the 27 financial year. As previously highlighted, profit before tax will follow a second half weighting profile similar to last year, reflecting seasonality of sales, timing of investments, and realisation of inflation mitigation actions. I think one thing that's interesting as well, so with Funky Pigeon, we've inadvertently covered it when we've gone over WH Smith a couple of times, but it's not a significant part of the WH Smith business. We have covered Moonpig, which is their larger competitor. So I couldn't actually find something that gave Funky Pigeon's market share, but Moonpig's is about 70% in the UK. So Funky Pigeon is significantly smaller, even combined with Card Factory's online sales. My view on that is that I think it's probably the best acquisition they could have made, given they probably can't afford to buy Moonpig, because I think Moonpig is bigger because it's on the FTSE 350. So yeah, I think it's probably the best acquisition that was available, but it's still the second best. I don't really see what Card Factory can do to really knock Moonpig off their perch. Funky Pigeon generates around 32 million in annual revenue. However, the 24 revenues for Moonpig were about 10 times that. So financially, it's just dominant. So I think it's a smart acquisition. It's the best they could do, but I think it's still not as good as Moonpig. If you look at the business over the past 5 years, it's actually done surprisingly well for a business that I kind of would have expected to be probably fairly representative of maybe the decline in UK high street. It's the kind of business you would have thought would have been put out of business by the Moonpigs and the Funky Pigeons. But in the past 5 years, revenue has nearly doubled. It does include the COVID year, but if we do it year on year, down 36%, up 28%, up 27%, up 10%, up 6%. So they're still growing revenue even once they've had that post-COVID year where they've kind of clawed back what they lost. Gross profit, that's gone up from 80 million to 190 million. And if you do the first post-COVID year, it's gone up from 116 million to 190 million. Operating margins improved from negative 2.6% to 14.6%. And again, if you take the first post-COVID year, it's improved from 8.6% to 14.6%. And the earnings per share has been increasing consistently as well, and the net profit. So it is a business that actually has been consistently getting better. In terms of the balance sheet over the past 5 years, the liabilities have been going down over that period. And I was actually quite surprised by this. So I did have a look as to what had caused it to have such a good 5 years, because given how well Moonpig's doing, I just didn't expect this. And apparently the main thing is they basically pivoted so that more of their sales really are coming from omni-channel. So they've shifted from being purely cards to more of a celebrations brand. So, you can get like gifts, balloons in store, confectionery, party supplies. They'll even do on-demand prints, similar to Moonpig. And now over 51% of the sales actually come from the non-card items. Additionally, they are vertically integrated. So they're the only vertically integrated greeting card retailer in the UK. So they control the design, the manufacture, and the distribution of the cards. Again, though, I feel like these changes, although they've been really good for Card Factory, they've probably been in response to what Moonpig was already doing. In terms of the valuation of the business, it trades at a PE of 6.8 and has a dividend yield of 5%. I actually think this isn't a bad little business. It's better than I would have expected, but my concern would always be that online Moonpig is dominant, and that's probably the problem. I think as the years go by, the proportion of people that will go and buy a card in store is probably going to be less and less. So for me, although I actually think it's a business that looks like it's been operated extremely well, they got new management in 2021. So that as well, have been more focused on partnerships, such as with Aldi UK and stuff like that. But again, I think the new management that came in 2021, which if you look at the results since they've come in, they've done a fantastic job. I think they've done as well with this business as they possibly could have done. If someone were to buy it, I think they could make a solid argument at that valuation and with those results. But for me, I would just prefer to have the best in class, which is Moonpig. So that would be my ultimate concern. What about you, John?
I would agree with you there. It would be Moonpig that I'd be wanting. And I think it comes with all those extra costs in Card Factory with the bricks and mortar side of things. I think that's always going to be difficult. So I would pay up for Moonpig if I were looking at one of these businesses.
What do you think of Card Factory on its own, though?
It's a difficult one because I think you could make a value argument for it, but I've been burnt on this sort of thing before, so I would probably just steer clear.
Yeah, right. But again, when you look at those figures, I think the valuation's actually pretty decent. But yeah, it's that long-term concern, I think, that's the ultimate issue.
Yeah, absolutely.
Should we move on to Greggs?
Yes, so we covered it lots of times on the show before. It's the High Street Baker. They had their Q3 trading statement out last week, with Greggs reporting a 6.1% rise in total sales over the third quarter, with like-for-like up 1.5%. Management called out weaker trading in July due to warm weather, which is interesting because we're used to the converse with a lot of these, certainly with the hospitality businesses, with trends improving in August and September. 57 net new shops have been opened so far this year, with the group now expecting to open 120 by the year's end. Previously, it was between 140 and 150. Full-year guidance is unchanged, which suggests operating profits will be modestly below 2024's level of £195 million. In terms of valuation, the group has a market cap of £1.67 billion and trades at 12.4 times forward earnings, compared with a 10-year average of 22.5%, and it has a prospective dividend yield of 4.3%, compared with a 10-year average of 2.6%. I think it's been a challenging year, whether you take the weather into account or not, with pressure on consumers. We've had increased payroll costs and the slowing growth, with the UK becoming more saturated with Greggs stores, certainly compared with 5 years ago. There's also been the expense of setting up the new distribution centres to go with the new stores, and particularly in the south of England, there are 2 new distribution centres. But they have a healthy balance sheet, and I think going forward, it actually now looks fairly valued for a more mature business that has what's shown to be an excellent management structure in place. It's more interesting, certainly for me, I think, looking at Greggs now than potentially a year, 18 months ago, when I think the valuation was still really quite high. And it felt like they were closer to that saturation point. So that at that point, I think we were certainly questioning where it goes from there, because it didn't look like it had the same level of growth ahead of it, although it was priced for it. So now I think it is much more reasonable. I'd say it's probably one for the watch list, and it's not a bad dividend either. It's not the best out there, but it's certainly not a bad one. So I think it's interesting. Sam, what are your thoughts on the trading statement and Greggs at its current valuation?
So I think the trading statement, so the main thing for me in that statement is the expectation of 120 new stores by year end, and that's been reduced from 140 to 150. I think that's kind of confirming what we've thought for a while, that they are getting to saturation. And I think that growth is going to continue to slow. And I think anyone buying it with an expectation they're going to get to the growth figures they were putting up previously, I think is probably going to be disappointed. As well, we've highlighted it as well in the past, there's a lot of levers they've pulled that they can't pull again. They've opened a lot of the stores for later hours. They've started doing more stuff in the evenings. But I think the valuation is pretty reasonable at about 12 for what Greggs is probably going to be going forward. But I think there's probably still quite a few people that own Greggs that are buying it because it's dropped quite a lot, and maybe are thinking that they're going to get some kind of multiple re-rating, which I just don't see unless things really pick up. The thing for me is, I think although it's a pretty fair valuation, I just think you can do better is the issue. So as an example, so Greggs 12.4 times earnings, yield of 4.3%. If you were to buy Domino's, you can get a P of about 10. So that's a bit lower, and the yield's at 5.86%. Domino's is probably more saturated than Greggs, so that might explain a bit of the difference. But even still, both very high quality businesses. Domino's is continuing to increase market share in the pizza market. I don't know how it keeps doing it, but it is still doing it. And I just think of the two, given there's not be amazing growth from either of them, I'd probably just rather have the higher yield and pay the lower price for Domino's, which is what I've been doing actually. I've started averaging into it recently. The results are okay. I think the valuation's okay. I just think you can do better.
Okay, fair enough. On to our next company then.
Yes, so I'm pretty sure this one is the debut for the show. So this one's DFS Furniture. Interestingly, again, it's a market cap of 372 million. So I think it's just outside the level. I think you need about 400, 450 million market cap to get into the FTSE 250. But it's just outside of that. But again, the share price, they're half what they were 10 years ago. So it's a business that will have been in the FTSE 250 historically. So DFS, for anyone who doesn't know them, they sell furniture. They have come out with their full year results. And firstly, they've highlighted that on a 52-week versus 52-week basis, the like-for-like order growth was 10.2%, which is pretty good. So they have made a point of highlighting that these figures are 52 weeks for the current year compared to 53 weeks in the prior year. So order intake growth was up 8.7%. Gross sales were up 5.8% to just under 1.4 billion. And the revenue was up 4.4% to just over $1 billion. Gross margin was up 70 basis points to 56.5%. Underlying profit before tax was up, it was about triple, from 10.5 to 30.2 million. And the reported profit before tax swung from a 1.7 million loss to a 32.9 million profit. Underlying basic earnings per share were up from 1.5 to 9.2p, and the reported basic earnings per share were up from negative 1.9 to positive 10.5p. Net bank debt was down about a third, from 164 to 107 million, and the bank leverage is down from 2.5x to 1.4x. They've highlighted that they've made market share gains. They've now got a record net promoter score, and they've achieved their 50 million cost to operate program 1 year ahead of schedule. They've said high-profile exclusive brand partnership ranges now account for over 40% of brand sales, and both the DFS and Sofology brands have gained market share in the year. And they've said Whilst our financial position has strengthened due to improved profit performance and disciplined cash management, our current leverage remains outside our target range of 0.5x to 1x, and the macro environment remains uncertain. As a result, the board has taken the decision not to recommend a dividend. I actually think they're in a position where they probably could have paid a dividend and it would have been fine, but it is nice to see management actually deciding what's best for the business instead of basing it on maybe how the shares will react. And I don't actually think when you look at the debt, it's at a hugely concerning level, especially compared to historical levels. They've done a good job at getting that down. But yeah, it's just I just think it's worth shouting out because I think it's really good to see management actually doing what they think is best for the business, irrespective of what the response might be. And it is unfortunately something that's incredibly rare because normally management are loath not to pay a dividend. And they said we will continue to focus on reducing debt levels, maintaining strong discipline on capital investment and bringing our leverage into our target range. In terms of the current trading outlook, there's not really much of interest in there, but they said longer term, the board remains confident of achieving their medium-term target of 1.4 billion full-year revenue and 8% profit before tax targets. So revenue is currently just over $1 billion, so that would be a 40% increase. And profit before tax at the minute, it's about 3%. So if they're wanting to get to 8%, they're going to need to cut some serious costs to get those margins up. But if they did that, the earnings would probably have to go through the roof, really. If you look at the business over the past 5 years, they're basically flat. So revenue's flat, gross profit is down slightly, but again, pretty flat. The margin's actually gotten worse over that period, and the net profit's down. So in terms of achieving that target, I'm not entirely sure how they're going to do that, but historically, something has to change. In terms of the valuation, the business trades at a PE of 17 and has a dividend yield of 0.6. Well, it has no dividend yield, actually. The historic yield is 0.68%, but they're not paying one this year. So there's no yield, and it's a PE of 17. I think that PE, if they can hit the targets, that's actually going to be pretty low. Maybe that's why it's at 17. I think if I was to look further at this, I'd want to know how they're actually planning to hit those targets. Because if they can and it seems achievable, it's probably a stock that could do very well. My initial reaction is based on the comments about the debt and the dividend. It seems like I quite like what I've seen from management, but it's such a ruthless industry. I would just have no interest in investing in it. So for me, I personally wouldn't bother to look any further. But if someone else wanted to, that's probably where I'd go. John, what do you think of the results and the valuation?
I think the results and the valuation are fair, and I appreciate what you say. My difficulty with it would be that it's so cyclical, and I think it's a really tricky industry. They may be a good operator, but it's an industry that I wouldn't really want exposure to. So for that reason, I wouldn't look any further.
Right. Shall we move on to a business we've not covered, I don't think, for a few years?
Yes. So Unite Group. Yeah, I don't know when the last time we covered it. I reckon it was probably 21, 22, something like that. It's the UK's largest student property group with the ownership of Unite UK Student Accommodation Fund and also the London Student Accommodation Joint Venture. So in terms of the highlights from the trading update, so they had 95.2% of beds sold for the 2025-26 academic year, compared with 97.5% for the 24-25 academic year. Sales to date deliver 4% rental growth over 25-26, compared with 8.2% for 24-25. Reiteration of the full year 25 guidance for adjusted EPS of between 45.5 and 48.25 pence a share, and rental growth driving modest valuation increases in Q3, which for Unite was flat, and for the London, the joint venture was 0.4%. Joe Lister, Unite Students' Chief Executive Officer, commented that we've sold 95% of beds and delivered rental growth of 4%. Whilst this is slightly below our target, we saw a strong clearing period, which has contributed to our outperformance of the wider sector. Looking ahead, the outlook remains robust, underpinned by growing demand from school leavers and stabilising international admissions. Our income is also underpinned by nomination agreements with long-term university partners, which now cover 59% of our beds. So essentially having block booking agreements with universities. Current trading, so the highest education sector update, they comment that the latest UCAS data shows that 512,000 undergraduate students have accepted places for the 25-26 academic year, 3% year-on-year increase. And the Home Office data shows a 7% growth in applications for study visas in the year to August, with applications in the peak summer months in line with 2024 levels. Overall, study visas remain at 11% below the 2023 levels prior to the introduction of the restrictions on dependent family members for postgraduate taught students. The outlook for international demand remains encouraging thanks to the growing student mobility and the increasing attractiveness of the UK as a study destination as competitor markets introduce more restrictive policies. 25-26 lettings performance, 95.2% of the rooms are now reserved for 25-26, with 59% beds let under nomination agreements for 25-26. That compares with 57% previously. Direct sales to international students are in line with 24-25, with fewer rooms sold to UK students and higher vacancy in a small number of regional cities. And the sales to date have delivered rental growth of 4%. They also mention the acquisition of Empiric Student Property. In relation to our offer to acquire Empiric Student Property, we were pleased to receive approval from Empiric shareholders. It started a pre-notification process ahead of commencing the formal Phase 1 investigation of the proposed acquisition. We anticipate that the scheme will be effective by the second quarter of 2026, subject to approval. And they comment that in terms of the fund valuation, so the larger Unite portfolio is valued at 2.8 billion, which is unchanged on a like-for-like basis during the quarter. And in terms of the property yields, they remain broadly stable at 5.2%. And the portfolio comprises of 22,361 beds in 56 properties across 17 university towns and cities in the UK. Coming to valuation, the group have a market cap of £3 billion and trade at 12 times forward earnings, and they have a dividend yield of 6.1%. I thought these results slightly disappointing, but I think, things have been slowing down. I think what's interesting particularly is that they still have a decent amount of debt on the balance sheet of around £1 billion. And you are seeing the expense of that creep up with rising interest rates. I don't have strong feelings on Unite. I think if you're looking in the property sector, there probably are more attractive businesses out there. And I'd be thinking specifically about Tritax Big Box REIT, primary health properties for, GP surgeries essentially, and also Supermarket Income REIT. All are producing higher dividends and I would probably argue are less volatile too. On the positive side, I think the UK does essentially export education, and by international standards, certainly when you look at the English-speaking world, the universities in the UK, it does have a number of high-performing ones, and they are significantly cheaper than their US peers in terms of fees. So I think it does draw a lot of internationals who generally do spend more on the accommodation. I think the other thing is that you do have the non-professional sort of amateur landlords who have a decent number of student properties. And with the increasing regulations on landlords, you do wonder whether there'll be more consolidation. I mean, you'd think looking at United's already pretty consolidated, but there could be scope for more of that, particularly if it's more onerous with those sort of short-ish term lets, and you could argue a slightly more troublesome group in terms of property damage, etc. So whether that does drive more people to Unite, it's certainly a possibility. But for me, I think there are just better players out there, and in the UK, there's no shortage of those. So that would probably be what would move me away from Unite. However, if you look at it, certainly on a valuation basis, it is cheaper than it's been for quite a few years. But maybe that is the demand moderating that little bit more. Sam, what are your thoughts on Unite?
Pretty similar. I think the results were fine. I appreciate the international students point, but I think in terms of home students, there's only so much you can squeeze out of them when loans aren't really going up with inflation. As well, it seems like there's a bit more of a push now for people to consider other options besides university. I think just given the amount of debt people are now taking on, I don't think it's quite like it was sort of 10 or 15 years ago where people just automatically did it. I think people are starting to question it a bit more.
Question paying Unite £10,000 a year for the room.
Well, I mean, that wouldn't even be the biggest expense, would it? Because I think Labour recently, just one sec, so they got rid of the 50% participation target for young people in higher education. I think that was the idea of that, is to encourage more people to go into apprenticeships and stuff like that. Whether it's under this government or another one, I think that trend's going to continue, because I think the value of a lot of degrees is quite questionable. So longer term, it's just the type of properties they've got, they're not really properties I'd really be that interested in, because it's not like I think the student market's one where it's just going to be an absolute boom for the next 10 or 20 years. And then if that falls away, well, they're probably just going to turn them into HMOs and they'll probably do okay. But I just think, 6% yield, what else can you get with a similar or higher yield? And like you say, there's much higher quality ones you can get. You can get PHP, you can get Tritax, you can get at AEW, we looked at last week. You can get supermarket income rate. So you'd have to go quite far down the list, really, before you got to Unite for me. And even then, I just don't think I'd want those kinds of properties. So I don't think it's a terrible read, but I just think at the moment, it does feel like we're spoiled for choice a bit with some of the quality of the REITs and the prices you can get them at. So I just wouldn't be interested.
And what do you think it is about the REITs at the moment that is causing that sort of re-rating of them? Do you think it's the rising interest rates?
I think it must be. But then a lot of them, they're not that. They'll be like 35% or 40% levered, but it's rare you'd see a REIT with more than kind of 40, 50% leverage. I know it will feed through, but a lot of these, even if the interest rates go up, they're kind of, some of them, there's some REITs where they have a lot of control over the pricing anyway, or the debt might be, we saw it last, I appreciate it's coming up quite soon, but with AEW, and we covered it last week, the debt's, they're still on 2% and a bit interest for the next couple of years. I don't know, but I think there's some really attractive ones at the minute.
Yeah, no, fair enough.
So should we move on to World Chess?
Yes, absolutely.
So World Chess, we've not got a US company this week because I wanted to have a look at World Chess. So for anyone who's not familiar with it, they are UK listed. They are absolutely tiny. So they've got a market cap of just under 13 million. So this is really small. They run FIDE Online Arena, the official platform of the International Chess Federation, where players can earn their FIDE recognised ratings online. So for anyone who's not familiar with FIDE, that's the official ratings platform. So to play in like tournaments and stuff like that, you need a FIDE rating. So when people say that the chess rating, that will usually be the FIDE one. Now, FIDE itself, I think, probably would have a lot of value, but when you dig into it, they don't actually own, they're not FIDE, they're not linked. So they've got like a long-term commercial partnership with FIDE where they're effectively paying for that license for certain uses. They don't really disclose how much they're paying for it. So it's difficult to actually get a measure of how much they need to be making to justify the cost of it. But yeah, they use that and they run the FIDE Online Arena. They also behind the Armageddon Championship series, which I've not seen, but I think it's like a TV series for rapid fire chess matches. I don't know what that's on, but I think that's pretty niche. And they're launching the World Chess Tour to bring together the game's top players. They also developed the official World Chess products, from iconic championship sets to innovative digital tools. So like, for example, the chess set used in the World Chess Championships, they design and make it. They do chess casting for live events. So basically, they're trying to sort of get into that commercial element of chess. So this company was only started it was founded in 2012, and they're trying to commercialize chess more. In terms of the results, so they've come out with their interim results for the 6 months ended 30 June 2025. Revenue, they report revenue in euros. Revenue was 1.1 million euros, and that was down from 1.2 million a year ago. Pre-tax loss was 2.1 million. That was higher than a 1.9 million loss a year ago. And I think, losing 2.1 million on revenue of 1.1 million is not good. And they fundraised 2.3 million in the year. They said revenue from the FIDE Online Arena was broadly flat compared to 2024. and they've closed the World Chess Club Berlin. They said it became popular, but commercially didn't deliver the results expected. After the end of the reporting period, they've raised another $2 million and issued more shares, and they've launched a few new sort of products and competitions. But really, as I kind of seen this was one of the company's reporting results. I thought, oh, what's that? I'll have a look at it. As you can see, it doesn't take a huge amount of looking to realise it's not really worth further investigation. If they actually owned FIDE or were FIDE themselves, it might be worth a look. The other thing is, if you wanted to kind of commercialise chess, if chess.com, for example, were publicly listed, which it isn't, that's the kind of thing you'd maybe take a look at, where it's like if someone wants to get into chess more, they tend to download chess.com and play that for free, and then they might upgrade to a membership or something like that. But these guys are just, it seems like just trying to pump money into sort of some of the commercial elements in the hope they'll get a return later on. And they might do, but based on the results, there's not really much to be optimistic about. And revenue's actually down. And they've somehow managed to make less money or lose more money on less revenue. So yeah, it just looks not worth further investigation. So I picked it not knowing that. I wouldn't look at it again. What about you, John?
Probably not. Okay.
Quite an easy pass.
Okay.
Should we, of the 6 companies then, Imperial Brands, Card Factory, Greggs, DFS, Unite, and World Chess, which do you like the most and which do you like the least?
I would probably go for Greggs actually at the top this week. And what do I like least? It would, well, if we set the chess aside, probably Card Factory.
So I think I'd probably put Card Factory number 1, actually.
Oh, wow, okay.
Yeah, I think I probably would, of those on offer. I actually think it looked like a decent little business. I wouldn't buy it because of the issue that is Moonpig, but at 6.8 times earnings, I think you could do quite well. And those earnings could be going up as well once Funky Pigeon's been integrated. That being said, with my own portfolio, in reality, it's not for me. It's just of these 6. Last, really easy, World Chess, uninvestable. If I exclude World Chess, it would be, I think, DFS, probably, but just the industry. It actually looked like a decent set of results.
Fair enough. Okay, well, thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.